Right, in this chapter I want to cover a couple of things. I want to cover relative strength as an indicator and also Bollinger Bands. Now with relative strength, this is more, again, I'm getting into discretionary trade measurement and a bit of idea generation. Sometimes what I'll look for is which are the leading sectors, which sectors, and it's all available for free on investingbetter.com anyway. You can see which are the leading sectors on the website. Which sectors are winning? It might be IT, whichever sector it is. Within that, I want to drill down and just look for specific stocks. So I'm looking for sectors which have relative strength and then individual stocks. And what I'm looking for with the individual stocks is I'm looking for some evidence of a high volume move out of a trading range. In other words, it's been going around and then we've got a breakout. So it's still looking for a breakout based on some high volume, because that'll give me an idea that I'm at my point X and that we're going to continue higher. So, give an example. RIM, classic example of a stock which was leading its sector in a leading sector. Then look at this. High volume, which came in here, and you had a bit of a breakout whilst it was doing this for so long. You had to break out, evidenced by a gap. Usually a gap on high volume suggests some degree of strength. You could put a stop loss fairly tight, which is just beneath the previous high. So, because if it falls back and fills the gap, I mean, it can go down and go up, but we want to keep a fairly tight stop, maybe, as I say, just there. But you've got this, you've got the volume, a bit of a breakout off it in a stock which was a leader in a leading sector. So the sector was winning, the stock has been winning, and it pushes out on high volume. It suggests to us we're going to go up. Now, chances are with something like this, you're going to put your initial profit target maybe there, and you might think, not tight enough. So in that case, not too great a reward given where our stop loss is, which is there, and given that our entry is only about here, we might think our risk reward is just not worth it for the trade. And in those circumstances, what you can do if you still want to do the trade is you don't enter the full position, maybe you enter half a position, wait for it to get to this level here where it's broken out through there, and then enter the full position for the remainder in any event. So you've got some evidence of the move. If you do look at the MACD, etc., etc., then you've got, again, further evidence that this breakout indeed was worthwhile, and that further evidence comes from the fact that the MACD is rising sharply, even though the stochastic is already overbought. And similarly, if you wanted evidence that it's likely to break through, they're not confirmed, this level here, that most recent high being a resistance, then you had it to some extent from the sharp moves upwards in the MACD, which suggested that it's going to have sufficient momentum to break through and not just hit that point and then turn back down again. So that's more the relative strength one, and it's more for an idea generation. I'd look at the news, see, yes, the news looks good as well, the MACD and stochastic looks good, this is one I like. Bollinger Bands in swing trading, I want to enter into. I would not use this by itself as a method. I use it more as something which is going to give me added on to, say, the MACD, the other indicators. Now, Bollinger Bands measure volatility. They measure the standard deviation of prices over a number of days. So you've got this average there, and then you've got this, which is a 2 standard deviation over a 20-day period, depending on what day period lookbacks you have. In other words, that is the average by which the price would vary if it went out by 2 standard deviations. Now, why is that important? Why am I talking such jargon? The reason is that gives us some idea of boundaries of how far the price is likely to go before pulling back. Prices can't go from 0 to 100 in a day. We know that. We know that after they get to a certain point, they're more likely to move back than continue upwards. Let's say the Dow was up 300 points. What are the odds? What are the odds you're going to put a bet that it's going to go more than that today? You're not. You're going to say, well, actually, there's a greater likelihood it's going to pull back off that. And that's what this is partly trying to capture. But the way I use it is twofold. First of all, if these bands narrow as they've done here, it suggests that the stock is about to have a big, sharp move in a direction. In other words, if volatility narrows, how do we know volatility has narrowed? Because the bands have narrowed. If these are two standard deviations, i.e. an example of, on average, how extreme the price might move, and they've become narrow, for instance here they're quite wide, then it suggests that the price is less volatile. In other words, it's not been doing all of this, it's just been doing this instead. And prices tend to revert back to their mean volatility, their average volatility. In other words, if the bands narrow, as they've done here, it means the price is about to break out sooner or later and become more volatile. It's going to become more volatile. Why? Because it's been less volatile, so it's going to revert back to mean, revert back to average volatility and become more volatile. Yeah? So that's BHP Bulletin. Well, what does that look like? Well, look at it. See how we had a narrowing? And bang! Very quickly, we got the increased volatility and we moved down ahead. We did indeed get a sharp rise and we got the warning signal from this. Now, as I said, normally I'd look for the other technical indicators as well on that, not just this alone, but we did get that warning system. There is another example that I use this, which is this. If the price does hit a Bollinger Band, so it's at its extreme volatility levels, then I'm a bit cautious because I know it's very difficult for the price to stay outside of that very long. You notice here it has to move back down, and then the Bollinger Band has to have room to move upwards, and the price at best just tracks it. Very difficult for the price to be above it and stay above it. Very unlikely for that to happen. Equally, once it's touched that extreme, you can see how we got a bit of a barrier, and that can tell us whether something's about to peter out. Now, it doesn't tell us in a formula where we can say, oh, if it does this and it moves down 1%, then we can exit. But it gives us a flavor, a feel, and something to look at and say, okay, look, let's just be a bit careful because it's easing off a bit. It's bound to ease off because it's near the peak of a Bollinger Band. But that is something I put into the pot. It's not something I can scientifically say, oh, it's tight, therefore it's going to move X% if it does this in 2 days. But it's more that it gives me an indication. Just watch out for it. If we've got other indicators, we might want to look for an upward move about to happen fairly soon. So that's that aspect for swing trading. And you can see for here, 520. So let's say we got out at 600. Let's say we didn't even get in at 520. Only got in at 550. That's a 30 pence rise. It's about 8% move. If you're using spread betting or whatever, you'd probably convert that into 20-25% rise. So it's moves like that which are typical for what we're looking for.